Hey class, welcome to Business Valuation and Financial Statement Analysis. I'm Elliot and I'm going to be your instructor this term. So looking forward to that, and I just wanted to take a few minutes to introduce a couple of concepts to you and also say that I'm going to be using a lot of my own material just because, in my opinion, the text does not cover a lot of the key concepts that make up the body of knowledge within the business valuation world. So with that, let me just go ahead and introduce a few things to you. So business valuation, well, first of all, business valuation is a little bit different than business analysis. Business analysis can just be any sort of ad hoc or any sort of financial analysis that somebody performs, whereas business valuation has the specific purpose of valuing the business or whatever the entity is. And the method, there are two different methods. You're going to be quantitative or qualitative. Quantitative is going to be, of course, your numbers. It's going to be general financial analysis, financial statement analysis, which includes income statement, cash flow statement, or your balance sheet analysis, and then, of course, ratio analysis, which takes numbers within those financial statements, and you compute different ratios with those and use those to interpret the company and its health. Qualitative, of course, is not numbers-based. It's more conceptual in nature. Competitive analysis is a good example where you're looking at different competitors. Market analysis looks at the industry in which the company is operating, and then a SWOT analysis is your strength, weakness, opportunity, threats analysis. So you're looking to grade or assess the company within those different quadrants. All right, scrolling down to here, I want to just say that there are two different types of companies. They're going to be a private one or a public one. The types of valuation that is done for each of those is very, very different. Public companies, you're going to have valuations for public investors like you and me just buying stock, institutional investors, which is going to be could be like an investment bank or a hedge fund or just a regular bank. And then there's a valuation for mergers and acquisitions. So mergers and acquisitions, M&A, that would be valuing a company, a public company, for taking over or merging with or acquiring a subsidiary. So then a private company, that's just going to be, that could be like your local mom and pop store, or it could be a large regional company that's just not publicly traded that needs to be valued. Then valuations are done for bankruptcy purposes, also done for litigation. An example of litigation would be a lost profits valuation, where the one company or the plaintiff asserts against the defendant that they caused an action that then resulted in lost profits for the plaintiff, and they're doing a valuation trying to seek retribution or recoupment of those lost profits. A divorce would be if there is a business, like a family business or a business that is related to a marriage in some way that has to be divided. Then you'd see CPAs or attorneys come in and value a business and then divide that up and either assign some portion of the value that's related to the business to each spouse and then be finished with it. So those are some of the examples. Again, public and private, they're two different types. We're mostly going to be covering valuation of private companies. So again, those are just some introductory concepts that I wanted to talk about. And if you have any questions or you just want to talk about anything, whatever, related to the class, the subject, then feel free to email or call me.